Hello everybody. In this video we are going to continuing the last class. So we started in TDS 115 in continuation with last video. We are now continuing. So we started with 5-step models. In first step 1 will be the identifying the contract with customer. Step 2 identifying performance obligations. Step 3 determining transaction price. Step 4 allocating the transaction price. Step 5 will be the calculating the revenue. Up to step 3 we have completed, and now we are going to allocating the transaction price in performance obligation, that is step 4. Anyway, at the end I will tell the summary. We will get the whole concepts at single point of time. Now we will go in detail for step 4. What is there in step 4, what explain in step 4. Now up to we know how we can calculate the transaction price, and now we need to allocate the transaction price in performance obligations. Now allocating the transaction price to each performance obligation in the contract in the ratio of SCMPE standalone selling price. We need to see the standalone selling price, but when we are standalone selling price is determined by using some priority basis. The price will be observable price of goods or services. Or if you have any similar contract, that means estimated price of goods or services. Here the observable price of goods or services means price at which it is sold separately by the entity. So observable price of goods or service means here the entity, if entity is sold separately, what is the price at which price it is selling, that is the observable price of goods or services. Or we can go with the estimated price of goods or services. For estimated price of goods or services we have 3 methods. One will be the adjusted market assessment approach, that is we need to adjust the competitor price, and second one will be the expected cost plus margin approach, so cost plus margin approach, and third one will be the residual approach. Here residual approach means we need to take the total transaction price of the contract, and from that we need to deduct the standalone selling price of other goods or services in the contract, then we will get the residual approach. So now we are discussing about step 4. In step 4 we need to allocate the transaction price. Allocation price will be allocated based on the standalone selling price of each performance obligation. Standalone selling price will be determined based on 2 methods. One will be observable pricing goods or services, another one will be the estimated price of goods or services. In estimated price of goods or services we have 3 methods. One is adjusted market assessment approach, and another one is expected cost plus margin approach, another one will be the residual approach. Now if there is any discounts, we need to adjust that discounts. So if you have any discounts in that discount also we need to allocate related to all performance obligations, the discount calculations. Here if there is any variable considerations, then also this variable consideration in transaction price we need to allocate the performance obligations. Firstly, how can we allocate this discounts? If the discount is not proportionally related to performance obligations, normally we need to allocate the discount in based on their entity's allocation transaction price. What is the transaction price? From transaction price we need to allocate. If discount contract is not proportionally related to all performance obligations, then entity is selling some product and we need to see the selling price. Also entities regularly sells some 2 other products in the some together value, then the steps will be, first we need to allocate that combined other products and remaining other. Now what we are expecting, I will take H product is there and B product is there, another one will be M product is there. Now first scenario will be we are allocating for all means we need to see the transaction price, we need to see the transaction price, we need to allocate for transaction price. Second method, what we are telling, if the discount in a contract is not proportionally related to all performance obligations. So if we normally in our market, this B and M already, if any person purchasing both, they are giving some prices. So first we need to allocate the discount to both, and after that for this is the discount allocations. Now we need to allocate the transaction price in all performance obligation in the ratio of revised SSP. So first we need to check out this SSP and this SSP, and for this SSP we need to allocate the transaction price, the discount amount. If there is any variable consideration, in transaction price, then allocate it to the performance obligation only when it is relates to, same example we can take. So H product is there, B product is there, M product is there, 3 product is there. Now the same products have selling for some amount, for example that are selling at 10k for 3, and these products SSP will be 9k and 2k and 1k. So they are selling at 9 plus 1 10, 10 plus 12. Normally if sell in individually it was be 12,000, but whenever we are purchasing both, they are selling at 10,000. Also there is variable consideration will be there on this M product. M is a good and it giving 400 variable considerations. Now we need to see, firstly we need to allocate the based on the transaction price, allocating transaction price, allocating with transaction price, allocation with transaction price, plus we need to add the 400 to this C only, because it is giving. Now some cases, if consideration in a contract with the customer is shown separately for different products, but it is not representing the standalone selling price of this product, then whatever the entity selling to customers, what is the price stated in the contract, we need to see, and the price stated was based, is there any variable consideration, and we need to see the amounts. Then allocate the transaction price in the contract ratio. If we have any contract, we need to enter, if we enter in the contract, we need to allocate total transaction price in the contract ratio, whether transaction price include fixed consideration or variable considerations. Now this is the main area. And last one will be the satisfying the performance obligation. Then we need to recognize the revenue recognition will be achieved here. Now entity shall recognize revenue when it satisfies the performance application in contract with customer. So whatever the terms is there, when the entity is satisfied the terms, then that means when the control of goods or services promised to the contract is transferred to customers. Transfer of control over here, if contract is transferred in a single point of time, if control transfer, the control is there, control is transferred single point of time, we need to recognize full revenue relating to that performance application at a point of time. If control is transferred over a period of time, the control was transferred, then recognize revenue that is calculated as per input or output method over a period of time. Here transfer of control of goods or service over a period of time or point of time. If it is over a period of time, then if any of the following conditions, means we need to see these conditions will be thick, we need to check out. Firstly is criteria 1, like customer simultaneously receives and consume the benefit as the entity performance. Then we need to see the customers receiving and consuming benefits as the entity performance. Means if entity is performing and person is receiving, entity is performing and customer is receiving simultaneously, means for example cable services or security services or accounting services or payroll services, these are all simultaneously entity need to perform, and then we need to get a benefit. Or we need to say another criteria, like customer control the asset as entity creates or enhance the asset. So is there any alternative use, or we need to see that alternative use, and the entity has asset created does not have any alternative use. If you have alternative use, or if does not have alternative use. Alternative use means, for example, it is building in working progress, so they may use for another purpose. If there is does not have any alternative use, and the entity has some enforceable right to receive any payments equal to cost incurred plus whatever the performance, we need to check out the performance. So if any of the following criteria is met, then we will go with the over period of point. So we need to recognize the revenue over a period of point. Now in case some cases the transfer of control in a point of time, indications will be here. The indication will be legal title, physical possessions, customer has significant risk and rewards, customer acceptance, entity has patent rights and payments. This all will be checked out in these cases. And some cases royalty will there. Royalty, so royalty means in case sale based royalty, that is revenue recognized when subsequent sales was occur, or performance application to which sales based royalty has been allocated is satisfied. Whichever is later we can check out. Based on that, we need to allocate the sale based royalty has a revenue recognition. So here we need to say subsequent sales were occur. Now after that, methods to measure percentage of progress to recognize revenue in case of performance application satisfied over a period of time. So for this we are controlling, we satisfy the conditions over a period of conditions was satisfied. Now how we can recognize this revenues over a period of time is satisfied. So when we have this over a period of time, then the amounts how we can recognize it. For recognition we have two methods, already we explained that two methods. So one is input method, one is output method, one is input method, another one is output method. And what is input method? Input method means here in this method the percentage of progress is calculated on the basis of whatever the cost incurred till the date to satisfy the performance obligation in the contract. So we need to check out the performance of progress. Performance of progress here, how we can get the cost, whatever the cost we are incurred divided by total estimated cost. What is the total estimated cost into 100, and from that we need to exclude the following cost in above formula for both numerator and denominator. Whatever the abnormal cost is there, we need to deduct that amount, and whatever the major components, cost of major component which is purchased and delivered to customer but not yet installed, that is like construction building of the elevator is there, the type of item. This is input method. And another method will be output method. In output method we need to, in this method we need to calculate the percentage of progress is calculated on the basis of goods or services transferred in relation to total goods or services to the transfer. Here we will go with the how much goods or services need to be transferred, how much we are transferred. Based on that we need to take out. Here for example we need to take a progress based on some independent surveyors will appointed, or we need to go with the SLM basis in case of services of goods or services to substantially saved. Now how can we accounting of revenue? Here generally normally when the accounting entries will start, revenue related to transaction only when control is transferred. When control is transferred, we need to recognize the sales entry. The sales entry will be simply debtor. We will get the debtor account debit to sales, simply the entry. And whenever payment was received, we need to create the amount whenever the payment is received from customer, but control of goods is not transferred. If control of goods is not transferred, then the entry whatever the we are receiving the amount means bank account debit to unearned incomes, means here the control is not transferred, payment is received. So it will be bank account debit to earned income. When control is transferred, is transferred and payment also received, means this is the reversal the amount when the control of goods is transferred to customers and payment is also received. So simply then the bank account debit to sales account. So directly if we are in credit basis, debtor account debit to sales. If control was transferred but amount was transferred, control was not transferred, so whenever payment is received, bank account debit to unearned incomes, and whenever control is transferred and payment is received, bank account debit to sales account. Now following now some items, means in the books of revenue related to transactions revenue, this revenue will be recognized in P&L in current period itself, and if it is a debtor, if the sale will be P&L and debtor will be current asset, if it is a contract liability, this is the unearned income will become the contract liability, or cost to whatever the expenses to be recognized in P&L in the current period itself. If it is a work in progress, means that is prepaid expenses, it also work in progress will be shown in prepaid expenses. That is the main area will be there. And for that whenever we are calculating the revenue to recognize it in previous profit and loss account in current period, firstly we need to check out the revenue. We need to record the revenue for P&L account. What is the revenue? Just a second here. Now we need to check out the revenue of current period, and first for that we need to calculate the current cumulative revenue. So cumulative revenue we need to calculate. Here the cumulative revenue will get simply the transaction price, whatever the total transaction price. From that we need to deduct whatever the cost of major components into what is the percentage of progress, we need to check out. And now calculating the revenue to recognize in profit and loss account in current period, what is the cumulative revenue to be recognized in P&L. So what is the cumulative revenue to be recognized, what is the revenue already recognized till date. So revenue already recognized, we need to deduct this amount, then we will get the revenue to be recognized in profit and loss account in current period, and that is the main area, and whatever the amounts. Next in here the some cases was here, whenever accounting for sale with right to return is there, that is repurchasing agreements was there, then what here repurchase agreement for forwards and sales, warranty means contract fulfillment, contract agreement, service agreement. The special cases, I think one special case was allocating revenue was provided, and this was subsequent measurement for conditions. Warranties will be not explained here. Estimating variable penalty, refundable liabilities. I think that yes, I missed this warranty portion. So warranty, here warranty, how can we account the warranty? So accounting warranty, we have two types of warranty. One, his customer has option to purchase separately, or customer does not have option to purchase separately. Here some if it can be purchased separately by the customer, it is known as service warranty, or does not have an option, then it will be assurance. It is inbuilt in the product due to requirement of law. So this is the main case. How we can give the accounting for this? Here like extending warranty. So normally company provide 1 year warranty. If you want, you paid some amount at a nominal amount, they will extend the warranty, that is extended warranty. Then it is treated, it has separate performance obligation. It will be treated as separate performance obligations. Then transaction price is allocated to it as per whatever the steps we are allocated is per step 4 in India is 115. The step 4 allocating the transaction price we discuss in the steps will be used. And whenever the customer does not have option to purchase separately, means it is inbuilt in the product due to some requirement of law. Here the treatment as per India 37, that is provision for contingent liabilities and contingent assets, we need to check out and make provisions for expected warranty obligations. Warranty obligation entry will be warranty expenses account debit to provision for warranty. This is the entry we need to provide. And here accounting for revenue in case of contract has renewal options at low prices is given to customer. So if we are given renewal option at low prices, then we need to check out what is the total estimated number of customers over a period on the basis of expected renewal rate, and we need to check out the what is the calculation total expected consideration. Here total number of customers, after that we need to check out the consideration over the period of using the total estimated number of customers. After that we need to divide this amount, so total number of customers divided total number of consideration, total consideration divided by total number of customers, and any extra amount received from customers, and the amount will be recognized as contract liability, that is unearned amount we need to recognize the cases. And after that in warranty obligation, is there any Mr. sale of right to return? Yes, sale of right to return. In here we are getting how can we account this sale of right to return. So in sale of right to return, entity shall recognize revenue for the products which are not expected to be returned. Here entity revenue for products which are not expected to be returned, or refund liability for product which are expected to be returned, and inventory assets at cost for its right to recover product which is expected to be returned. So here we have three cases. We have revenue for the product, but we are not, which are not expected to be returned one amount, and we have some refund liability for the product which are expected to be returned, so we need to return in some cases. And another one will be inventory cost. That inventory cost will be accounted as the cost. The entries will be the bank account debit to sales to refund liability, and inventory entry will be inventory account debit to profit and loss account. Whatever the amount of restocking fees, that is fee charged on refund returned product has compensation for packing and ship, is also recognized for cost. And after that refund liabilities concerning variable considerations, these are counted. And penalties, variable considerations, long term non-legal fees, and customers additional product, principal purchase agents, distinct product, goods and services. Next some legal points, consignments was there, accounting modifications was there. This was explained multiple, these are explained. And non-refundable fees, concerning variable considerations, how we can account for it. What is the cases? Last case, allocation of transaction price is started now. Here we have some cases now. Contract cost, repurchase agreement, and this repurchase agreement, service concession agreement, contract cost. So what is the combined contract? What is the contractual? What is the cost? Service concession contract. Service concession arrangement means simply here it is an agreement. In which the entity, it is an agreement in which the entity, that is means operator, enter into a contract with customer or grantor, means maybe some persons, for constructing and operating in infrastructure for public services, like some toll roads is there, Now that infrastructure constructed and operated by entity for government is not for PP of an entity. So for example, we have in Rishikonda they build one building. The building was for the purpose of government. It is not property of the particular party. Now that infrastructure constructed and operated by the entity for government is not a PP of the entity. How we can account for that revenue? Or we have in national highway some toll roads will be there. Toll charges will be they will construct the toll roads, they will collect the toll charges for up to some years. After that they need to leave to government. It is property for the governments. Now accounting, how entity will account this revenue. If entity has right to receive fixed amount of cash from government, if government is offering some direct amount, then recognize that whatever the amount we are receiving fixed amount as a financial asset as per Ind AS 109. We need to recognize as per Ind AS 109. Now what is the general entries in if it is in construction phase? So it will be financial asset debit to sales, financial asset debit to sales. And whenever it is in operation phase, financial asset debit to financial incomes, and financial asset to sales, or the amount was received bank account debit to financial asset into credit. But some cases what the government will do, the government will not give the any fixed amount. They tell that you can use this toll and collect the toll charges up to certain years, and after that you may need to leave the asset. So here if entity has right to collect toll from users of public infrastructure and recognize the right to collect tolls as per Ind AS 38, that is intangible asset here. If it is government is giving directly amount, it will go with the Ind AS 109. If government is giving right to collect, then it will be intangible asset. So then we need to recognize intangible asset account debit to sales account, and the amount we need to amortize this intangible assets, amortization account debit to intangible assets. After that bank account debit to sales account. This is the accounting treatment for this service concession agreement. And after the service concession agreement, we see that here we have principal and agent. Here the concept will be principal and agent contract. Here we have seen principal and agent contract. Now what is this principal and agent contract? It is also important. Now principal and versus agent. Here if entity is performing as a principal, how we can account? If entity is performing as an agent, how we can perform and recognize? Here if it is a principal, then in their PNL, in their profit and loss account, if it is a principal, the PNL will be, then the entity will recognize revenue gross amount they need to recognize it, and whatever the expenses they incurred they need to recognize the amount. If it is a agent PNL, the revenue will be the only the commission amount. This expenses amount will come into income. This commission will be the expense for the principal. Now here if how we can treat is a person principal or agent. For that we need to see the conditions. 3 conditions will be required. One is primarily entity is primarily responsible for fulfilling the contract. What are the contract conditions is there? The primary responsibility for the entity, then it will become the principal. And if the entity has inventory risk, so if entity has inventory risk, or if entity has discretion in setting the prices, if it has discretion in setting prices, then it will be treated as principal. It will be treated as treatment. Next after that, this is consignment arrangement. What is meant by consignment arrangement? Consignment arrangement means simply entity, here consignor will come into picture, shall recognize only when the control of goods is transferred to the consignee or end customers. So normally what happen in consignment, here one person is there, consignor, and one person is there, consignee is there. He will give the goods on 6 months. He will also give 6 months time. Up to 6 months he has time. He can sell that product. Or if the product is not going in the market, he can reverse this product. So only the consignor recognize revenue after 6 months or after the sale is happened, then only they need to recognize the revenue. Up to that they did not allow to recognize the revenue for this product, whichever the products they are providing. This is the main concept for consignment arrangements. After that, distinct goods multiple it was stated, and in the performance application next year, variable consideration, penalty, refund liabilities considerations, warranty concept completed, measurement, non-cash considerations, transaction price we are discussed, transaction power report completed, service concession agreement, and contacts. This contacts maybe combined contacts and repurchase agreement. This is main one is repurchase agreement. So this is a repurchase agreement. How we can account for repurchase agreement? Now here we need to see repurchase agreement. Simply for repurchase agreement we have forward agreement, call options and put options. We have 3 options. One is forward, one is call, one is put. How we can account for forward agreement? Here entity sell the goods but promise to repurchase of fixed date. Here the amount obligation, the entity has obligation to repurchase the asset. The obligation will be fixed amount and fixed date will be there. Same as entity call option. In call option also entity has right to repurchase the asset. So for these two accounting will be the taking in same. Here how we can account for this? Firstly we need to see repurchase amount. If we repurchase amount is greater than or equal to, or repurchase amount is less than. So for which amount we need to see? For this amount was greater than or less than original selling price. You need to see original selling price. Then if it is greater than or equal to, then it is financing arrangement. Means it is financing arrangement, that is loan contract. It is loan contract. Here we need to apply the TDS 109 financial instrument. We need to recognize the financial liability of consideration received at the beginning. Whatever the amount we are receiving means entry bank account debit to financial liability. We need to recognize the entry and recognize difference, whatever the difference between the consideration received at the beginning and amount payable at the time of repurchase as finance cost. Different amount will be treated as finance cost. So finance cost debit to financial liability at the time of repurchase. So the financial liability will be debited to bank we are paying. Now another case will be less than the selling price, then it will be lease arrangement. So it will be lease arrangement. If it is greater than or equal to, it will be financing arrangement. If it is less than, you need to lease agreement. If it is greater than, we need to go with the TDS 109. If it is less, lease agreement, we need to go with the 116. Here we need to recognize the consideration received at the beginning has a deposit liability and extent of amount repurchase, and whatever the amount unearned lease amount for the balance amount. So here the entries will be simply bank account debit we are receiving to deposit liability to unearned income. We need to recognize the entry, and whenever the over a period of time we need to recognize the lease income from this unearned income. So unearned income will be debited to lease income. So at the time of repurchase, so we need to close that deposit liability to bank account. This is the case for forwards and options. After that we have put options. So for put options we have entity here sell the goods. Means here entity sell the goods, but the contract customer has an option to sell back the goods to the entity at a fixed price at a fixed date. So here he has a right to sell. Now it is likely the customer will exercise. Then it is the put option. If we exercise the put option, if repurchase price, when repurchase price is greater than or equal to the original selling price, the or expected market price of the goods at the repurchase, then we need to account as per the forward agreement or call options, or otherwise we need to recognize like a sale with right to return concept. We need to use the arrangement. Next, contract cost. Here contract cost concept means simply what is the contract acquisition cost. Means here contract acquisition cost, sunk cost, that is cost incurred when contract is done or not, whether the contract is done or not, we need to see. So that is like a sunk cost. Here sale person is traveling for expenses, we incur some expenses, that is sunk cost. No, we need to transfer it to profit and loss account. Contract acquisition cost, whatever the cost, sale commission, expenses, it will be expenses we need to incurred. Or if it is incremental cost obtain the contract, it cost incurred only when contract is done. So it is a sale commission, it will be incremental cost. So obtain the contract, cost incurred only when contract is done. Then we need to recognize it is to recognize at as working progress and amortize the overpaid. If it is a sunk cost, we need to transfer it to P&L, recognize the amount in a P&L, cost to amount cases, not the standard directly amount. And when the contract fulfillment is there, cost incurred to fulfill the contract, for example market, labor, etc. in the construction, cost of building. So whatever the cost we are incurred directly or related or anticipated, expected. Now if costs are covered in any other India, if any other is covered that cost, for example India 1638, we need to see and account as per that India. If there the cost are not covered by any other Indias, we need to recognize it as working progress and amortize over a period of time. This is the concept for contact customers. So contact customer was completed. Now repurchase agreement was completed, principal agent was completed. Now we will see the what is the summary of the entire India 115, what the it explained for India 115. After that India what is the summary, entire summary will be explained in short. Just a second of it. So we started with revenue from contact with customer. Here simply for the summary we start revenue means simply one business was started, we need to get the revenue. For that purpose we will do the business. How we can account the revenue from the contact with customer to provide goods or services in entity in ordinary course of business. For that we have 5 steps. For entity shall recognize revenue when it is satisfied the performance obligation in the contact with customer. So for that we have 5 steps. One step will be identifying the customers performance obligations, the transaction price, allocating transaction price, recognize the revenue. These are the 5 steps. So the first step, identifying the contact customers, means here the agreement done by the entity with a customer will be considered as contract with customer under India if it is satisfied the all conditions, whatever the conditions were there, and that need to satisfy. It should be provided goods or services to customer in entity in ordinary course of business, and approved will be entity and customer have the approved, means it may be either writing or orally, and entity and customer has identifiable their rights and identify the payment terms, and probable that entity will collect consideration from the customers, and both the entity and customer will have enforceable rights. Then we need to recognize the amounts. So recognize the amounts, recognize the revenue when the entity has transferred the all promised goods or all promised goods to the customers, that is, and full consideration is received. If it is non-refundable, then we need to recognize the revenue, and contract is terminated or consideration is received which is non-refundable, then also we need to recognize the revenue. That is the main case for this first amount. Then when the entity was giving the considerations. Next, combining contract. Combining contract means here simply entity shall combine two or more contract entered with same customer at or near the same time as a single contract if contract or negotiated as a single package. Contract or negotiated as a single package, or consideration of one contract depends on price or performance of other contract, or goods or services performed in a contract in a single performance obligations. These all are known as the single combined contract. So if we are satisfied these conditions, both three conditions, then we need to consider it as combined contract. The three conditions will be simply contract is negotiated, single package, single commercial object, single package is there, single amount is there, and consideration of one contract depends on the price or performance of the other contract. So they have dependence, and the goods or services promised in contract in single performance obligation. So then if three conditions are satisfied, it is a combined contract, single contract. If it is not, it will be treated as separate contract. And this is the main case we are provided here. And after that, modifications. How we can account for the modifications? Modification in contract with customers. Here for modification, we can see whether the modification, the four terms, 1 2 3 4 here. The first one means modification results in addition of goods or services in the contract. Why we are modifying? Because we are adding some goods, we are increasing the promised goods or services in the contract, and the price in the contract increased by that SSP of additional goods. Then we need to treat it as a separate contract. So here modification is there. Modification reason will be we are adding some goods or services in the contract, and we also added the price of the contract, we are increased the SSP for the additional goods, then it will be treated as separate contract. Now another cases will be, what is the another case? Here modification results in change in price of existing goods or services. So why we are changing? The means simply modification results price of existing goods or services, or modification results in addition of goods or services in the contract, but price in the contract not increased by SSP additional goods or services. Then the amount, whatever the amount, termination of old contract, and we need to create the contract, we need to terminate the old contract, we need to create the new contract. That is consideration for remaining goods or services is recognized as revenue over a remaining period of time, And another last one will be the modification result in increasing in labor hours in construction contract. So we are increasing the labor hours, that is the main reasons. Or the any other case of modification, then we need to treat it as as a part of existing contract, that is adjust revenue of cumulative catch-up basis. We need to adjust the cumulative catch-up basis. This is the first step 1. And after that, step 2, we started with step 2, the here identifying the performance obligation in the contract. For this, performance obligation means promising to customer of transferring. So here the distinction we need to see, the distinction will be distinction of goods or services is there or not, and series of goods or services that are substantially the firstly distinction means each distincting goods or services a contract is treated as separate performance obligations, whatever the each goods or services. In this case, revenue for each distinctive goods or services is recognized by entity when the control is transferred to the control. Now what is the meaning of this distinct? Distinct means here if customer can benefit from the goods or services on alone basis or with other readily available resources. Readily available resources means here can be purchased separately in the market. Here this will be the distinct. And in some cases what will happen in some cases, here we have series of goods, we are promising series of goods that are substantially the same and have the same pattern of transfer to customers, that is customer receive the benefit as it is provided, then it will be treated as single performance obligation. In this case, revenue is generally recognized on SLM basis. We need to go with the SLM basis. We need to use for this type of cases, SLM basis. Next, after that we next year here we have same customer, multiple elements of arrangement is there, and then which can in that cases for goods or services which cannot be treated as distinct even it is satisfy the conditions. The conditions for this is customer can benefit either alone or readily available resources, and readily available resources means this one, and identifiable from the promises. If satisfied, it will be distinct. But some cases, even though they are satisfied, that will not be treated as distinct goods. For example, entity has significant integration. So was there significantly they are performing cases. Now significantly they are integration. Here entity is using multiple goods or services to provide to customer a final product is asking. So the final product is one which is asked by the customer. For that entity using different services, then it will not be treated as separate, even though the individually it will not be calculated. For example, marriage event we are taken in the question. In marriage event we have catering service, video service, editing, so photos, etc. But ultimate customer want entire marriage event will be single performance obligations here, because in another all or significant integration will be required, or if the goods or services significantly modifies or customizes other goods or services. So for example, entity has some providing some customized software will be required, then it will be treated as single performance applications, even though they are entity providing different different performance application for entity. If goods or services are highly dependent or interrelated was there, then also we need to treat it as single performance obligations. This is the main area which we are discussed. After that, here consignment arrangement means we explain that consignment arrangement over here the consignor and consignee will be there, and that consignor and consignor will give time for the consignee, and only when the revenue will be recognized only when the customer of goods is transferred to the consignee, or it will be transferred to the end customer. So if the conditions will be need to transfer, customer consignee does not have any obligation to pay consignor until the goods are sold to customers, or consignor is able to ask for return the goods provided to consignee. Consignor is able to require a consignee to transfer goods or services. So yes, this is the consignment arrangement. After that, principal versus agent. Here the principal versus agent means simply the if entity is performing entity is performing as a principal, or if entity is performing as a agent. Performing as a principal, then they need to recognize the gross amount as revenue, that is total amount, and if entity performing as a agent, they will recognize revenue on a net basis, then only the commission amount. Here the how we can treat it as a person have principal or agent. For principal, they need to transfer the conditions. With the conditions will be three conditions. One condition will be the entity has primary responsibility for fulfilling the goods, and entity has inventory, and entity have discretion in setting the prices. This is the principal and agent was the conditions. And whenever the entity was provided just a second. Long term and non-refundable. So third step will be determining the transaction price. Here for determining the transaction price means simply consideration that entity expects for transferring goods or services to customers. Here exclude the amount collected on behalf of third party, like some GST, VAT, custom, CST we are collected. We need to exclude that amount. Transaction price will include whatever the amount. Here we transaction price will how consideration payable to customer, non-cash considerations constraining estimate of variable consideration, significant finance concept. So this 5 are we need to explain. For that, before we need to know about the variable consideration and fixed consideration. Fixed consideration is simple. Fixed consideration means simply the amount, it is fixed amount mentioned in the contract, it always be included in transaction price. And the variable consideration, now variable consideration, it is the amount of consideration depend on the future event, based on their performance they will provide. It is the include in transaction price on the basis of entity's estimation of receiving that consideration. So here for this calculation we need to have 3 methods. One is expected value method and another 2 methods. One is expected value method, one is most likely method. Expected value method means it is generally used if there are more than 2 possible outcomes. Here we have 2 possible outcomes, and in this method expected value, whatever the probability weight amount for range of consideration is taken into variable considerations. And here the amount, what is the amount, simply what is the estimated consideration, it is the estimated consideration into probability is equal to, we will get the total amount of variable consideration. For variable consideration divided by the weighted average number of units we will taking. This is expected value method. And another one will be the most likely method. So most likely method, it is generally used if there are only 2 possible outcomes, that is it will be heads or it will be tails. So in this method only single most likely amount we need to consider, that as taken as a variable considerations. Here entities it shall include variable consideration only to the extent that it is highly probable that significant reversal of revenue recognized will not appear in the future. In some cases variable consideration will not be included. In some cases variable consideration will not be included. Variable consideration will not be included. How? Cases if consider it is dependent on factors outside the entity influence like market volatility. These are all the cases. This will be does not consider for variable consideration in transaction price, or amount of prices considerations in consideration which entity generally provides the similar contract. We need to does not refunding this liability will not be considering here cases. Next here after that step, sale with right to returns. So for that sale to right to returns will be there. How we can account this? Entity shall recognize here 3 items. One is revenue for the product which are not expected to be returned, that will be recognized, and another one will be refund liability for the products which are expected to be returned. We need to recognize that one. And another one will be inventory assets account, inventory assets at cost for its right to receive cover product which is expected to be returned. This will be recognized here. Whatever the amount here we need to give. And the variable consideration at every end of the reporting period we need to reassess the amounts. Whatever the amount we given we need to assess in every considerations. And another one will be here we non-refundable cash. So consideration, this consideration was there, and some cases it will be non-cash. So non-cash considerations. If consideration, it means consideration in the form of other than cash, like we are giving share of customers, company, advertising by customers or equipment. Entity shall include non-cash consideration in transaction price at fair value of non-cash consideration received from the quantity. If it cannot reliably estimated, then we need to assume the complete transaction price as equal to standalone selling prices. It is the case, and transaction price need to be adjusted for components. Now we have significant component, financing component effect. Normally consideration payable by the customer by the entity, we need to adjust. If the payment for the distinct goods or services received from the customer, so we are received, payment is known, then we do not adjust any transaction price, then we need to recognize the purchase of goods or services from customers. Now how we can account for this significant effect, significant effect? So here we are explained this non-cash considerations and effect of significant financing component. Here significant financing component means simply it is their time gap, it is their time gap between the satisfaction of the performance obligation by the entity and the payment consideration by the customer. Then there are some significant component in the contract. Now in this case the such significant financing components is adjusted from the transaction price. So if entity satisfies its performance obligation but customer make the payment on later date, that is loan by the entity to customers. Now entity shall recognize revenue at normal selling price. So normal selling price we need to account as normal selling price, and we need to whatever the extra amount we are receiving over the cash selling price will be treated as interest income, that is financing income will be treated it as financing income. Over a period of credit period we need to transfer it to profit and loss account at discounting rate. Here we need to use the financial instrument standards. Here if cash selling price is not given in the question, then we need to cash selling price will cost of goods sold plus we need to add some margins. Or if another method will be present value of future cash inflows at discounting rate. Here the discounting rate will be used, the discounting rate will be used incremental borrowing rate, that is actual interest rate in separate financing transaction, or otherwise consider IRR rate in the contract of the entity. That is the main case. And after that we have next non-cash consideration is completed. Measurement of consideration payable by customers. So consideration payable by the customers, we explain that consideration whatever they are paying distinct is there, we need to consider it transaction prices. After that step 4 will be allocating the price, transaction price in performance obligation, allocating the transaction price each performance obligation in the contract in the ratio of SSP. We need to go with the SSP of each performance obligation. For year determining using the priority basis we need to go. For that we need to observable price we need to check out, and price at which the sold separated by the entity, or we can go with the estimated method. So for estimated methods we have 3 methods. Estimated price we have 3 methods. One is adjusted market approach, another one will be expected cost plus margin approach, another one will be residual approach. Here we need to adjust, and if there is a discount is there we need to adjust same as the SSP, and if the SSP if other 2 products or 3 products is giving the discount we need to adjust for that same firstly. And after that we have discount allocation. Next variable consideration allocation. So here the variable consideration allocation simply allocating the transaction price. If consideration in a contract with customer is shown separately for different product but it is not representing selling price of the case. Now after that we need to satisfying the performance obligation, so we need to recognize the revenue. Entity shall recognize the revenue when it is satisfied the performance obligation in the contract with the customer, that is when control of goods or services promised to the goods are transferred to customers. So if the control is transferred single point of time we need to recognize the revenue single point of time. If the control is transferred over a period of time we need to recognize over a period of time. So transfer of control goods or services over a period of time, so over a period of time we need to check out the conditions. If any of these conditions is satisfied we need to recognize it as over a period of time. So when his customer has simultaneously receiving and consuming the benefits as the entity performance, whenever the entity performing customer is getting the benefit, then it will be over a period of time. Customer control the asset has entity creates or enhance the assets, that is billing working progress is there, then it will be recognized over a period of time. Asset created does not have any alternative use to entity, and entity has enforceable right to receive payment equal to cost incurred plus margin of performance till the cases of termination. So whatever the expenditure we are incurring, based on that we need to recognize the income over a period. In case of sale based royalties, in case of sale based royalties, then we need to check out the revenue recognition, what is the subsequent sales was occur, and performance application which is based was the provided in the cases. And after that repurchase agreement. So repurchase agreement means here we have three cases. One is forward, one is forward, after the forward one is call option, and another one will be the put option. So for forwards and call options, same, we need to check out the reselling prices. Reselling prices with original selling prices. The prices was above the amount or below the amount, we need to check out. Based on that we need to account for it. And after that, service concession agreement. Here the service concession agreement means simply the if an entity operating the entity in the contact with customer or some government is they are constructing some infrastructures, their government was allocating full amount, they will to recognize the amount. If government is given right, if they are giving amount directly, then it will be account as per Ind AS 109. If government is given right to collect the amount from the users as a toll charges, then it will be accounting as a Ind AS 38 intangible asset. That is the main here. And last one will be the contract cost. In contract cost, contract acquisition cost or contract fulfillment cost. Contract acquisition cost has two types. One is incremental cost to obtain the contract, that is cost incurred only when contract is done, that is like sale commissions. Then we need to recognize the working progress asset and amortize over a period of time. Some cases the cost incurred whether the contract is done or not, it will be sunk cost, we need to recognize it as P&L, profit and loss account. And contract fulfillment cost means cost incurred to fulfill the contract, that is labor, material, etc. construction. If the costs are covered by any other Ind AS, we need to go with the other Ind AS. If he does not have any other Ind AS, we need to recognize as working progress and amortize over a period of time. This is the summary for Ind AS 115.